Hey guys, check this out. You're looking at the chart of the overnight of the E-mini on Tuesday, June 6th. And here the market closed right over here at 42.88, okay? So I drew a horizontal line right at the close. I marked the close and I carried it over. Now, just look at where the candles traded, where prices traded overnight between June 6th and June 7th. Just about, and look, there are 4 points between each horizontal line on this chart. Only 4 points, so that's not a lot. The market gyrated, prices gyrated about 4 points between the, from the high to the low, from up and down of the close on Tuesday. So on Wednesday, the market opened about 4 points, no, about 3 points above where they closed on Tuesday. And so when the market opened up, and this is the 9:30 candle, the 9:30 candle on Wednesday, June 7th, and the candle immediately shot up. The market shot up, came back a little, kept going up till they were 43.04 immediately. What happened overnight to cause this to happen? Now, if there was some good news overnight, the market would have opened much higher, above where they closed on Tuesday, but they didn't. Instead, they opened just about 3 points above where they closed on Tuesday, which is almost flat, okay? And then they shot up. Why did they shoot up? Certainly, if there were good news, it would have gone up significantly and opened significantly above the gap. It didn't, so it shot up immediately. And then what happened? Now, I had my trading zone marked out on my chart. You see the green rectangle, that's my Taylor trading zone. I calculate it every day to give me an indication of where the market is likely to trade. And I'm looking at the open, and I'm looking at, now these are 3-minute candles. I'm looking at the open, and I'm seeing that in the first 12 minutes of trading, the market went up to 43.04, about, 16 points above where they opened. Why? No reason. Why? And quickly. Because look what happened. I'm looking at my prices. I'm looking at my trading zone. Now you can chase the market, or you can read the tea leaves. Now the tea leaves are, I use the stochastics, I use the Taylor trading zone, and I use the price action. The price action doesn't comport to anything that caused prices to rise like this at the open. So I'm looking at this and I'm going to wait, because I don't think that prices are going to hit the high of my trading zone, my resistance number at 43.10. So my 43.10 is up here. And sure enough, when they hit 43.04, they hit a ceiling, bumped their head on that ceiling, and then started to decline. So where were prices going to end up? Now, by 10:30, I saw that the intraday high was put in just after the open, 12 minutes after the open at 43.04. So I'm figuring the prices are going to trade within the Taylor trading zone, and they're going to move down to the support area of the Taylor trading zone, which was what? So my calculated support was down here at 42.80, 42.79, and my trading zone gives me a range of where it's going to trade. So if I take my trading zone and I'm going to clone it, see, I'm going to clone it. I'm using TradingView here. I'm going to clone it, and I'm going to move the clone down to where the top of the clone matches the intraday high at 43.04. And it shows me that the market is probably going to trade down to 42.74, 73. And what happened? The market traded down to 42.73. So that's how you use the Taylor trading zone in conjunction with looking at how prices open based on where they closed the previous day and what happens overnight. Certainly, if there was any good news, prices would have opened much higher, but they didn't. They actually shot up exactly when the market was open in order to lure people in to trade to the upside when the powers that be were going to take the market down. So that's my video for today. Marv Eisen for Timeless Dollar Trading Academy. It's Thursday, June 8th. Have a great day. Trade safely. Use lots of patience. Thanks for watching, and I'll see you in my next video.